everyone, and welcome back to the Client Classroom. Today I want to talk about what I think is one of the biggest and sometimes most expensive mistake that people can make when they have company stock inside their 401k. And that's the mistake of rolling the entire account value into an IRA without first taking a look at something that's called Net Unrealized Appreciation, or NUA. Because if you miss this opportunity, it can permanently change how that stock gets taxed. Sometimes it's the difference between paying ordinary income tax on everything versus having a portion taxed at capital gains rates instead. So let's walk through what this actually means. NUA is simply the difference between what your employer stock originally cost inside your 401k and what it's worth today. Normally, when money comes out of a retirement account like a 401k or an IRA, everything is taxed as ordinary income. But employer stock is one of those rare exceptions. If it's handled correctly, the growth on that stock inside the plan may qualify for long-term capital gains treatment instead. And that's really where the opportunity comes from. Here's what I see happen all the time. Someone retires or changes jobs, they move their 401k into an IRA, and they include the company stock in that rollover. Once that happens, the NUA opportunity is usually gone forever. So the key is reviewing this before you do any rollover. Here's the basic structure of how a qualifying NUA transaction works. First, the employer stock is distributed as shares, not cash, from the 401k. Next, those shares move into a taxable brokerage account. And finally, the rest of the retirement plan assets can still roll into an IRA if that's appropriate. And the tax treatment gets split into two pieces. The original cost basis is taxed as ordinary income in the year of distribution. The appreciation, though, inside the plan gets taxed later as long-term capital gains when those shares are sold. And that's the key advantage. Let me show you what this might look like in real life. So let's say inside your 401k, you own company stock worth $300,000 today, but the original cost basis is only $60,000. That means there's $240,000 of appreciation. If you roll the stock into an IRA, eventually when withdrawals happen, the entire $300,000 gets taxed as ordinary income, which is typically higher rates than capital gains rates. But if you use an NUA strategy instead, the $60,000 basis gets taxed as ordinary income today, and the $240,000 gain becomes eligible for long-term capital gains treatment later. That difference alone can create significant tax savings depending on your situation. And any additional growth after the shares leave the 401k is taxed based on how long you hold them in the brokerage account. There's one additional detail that's important to understand if you're under the age of 59 and a half. You could still use the NUA strategy before 59 and a half in certain situations, like after separating from service, but the cost basis portion that becomes taxable today may also be subject to that 10% early withdrawal penalty unless an exception applies. The NUA portion itself is generally not subject to that penalty, only the portion taxed as ordinary income. And timing matters here. If you separate from service in the year you turn age 55 or later, the age 55 rule may allow you to avoid that 10% penalty on that taxable portion, even if you're still under the age of 59 and a half. So age and timing can make a meaningful difference when evaluating whether this strategy makes sense. NUA is usually most attractive when the stock has substantial appreciation, the cost basis is relatively low compared to its current value, and your ordinary income tax rate is higher than the capital gains rate. In those situations, shifting part of the taxation from ordinary income to capital gains can be very powerful. On the other hand, NUA may not make sense if the stock hasn't appreciated very much, if you expect your future tax rate to be much lower, if you want to defer taxes as long as possible, or if you're already too concentrated in one company stock and need immediate diversification. So it's definitely not automatic, but it's always worth reviewing. Here's the most important point. If you have company stock inside your 401k, don't automatically roll everything into an IRA without checking whether NUA applies first. Because once the rollover happens, the opportunity is usually gone. And a short conversation ahead of time can make a meaningful difference in how that stock is taxed for the rest of your retirement planning strategy. If you have questions on this or any other topic, we're happy to help. You could reach out and schedule an appointment on caserta-dejong.com, or you could just give us a call. We'll see you next time in class.